SpaceX is going public. Valuation, $1.75 trillion. Pause. And within weeks, your retirement account could automatically buy it, whether you want to or not. You won't get a warning. You won't get a text. You won't even get an email. Let that sink in. 1.75 trillion. That is bigger than Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. That is bigger than every major American defense contractor combined. That is bigger than the top 10 companies in London combined. So here's the question Wall Street doesn't want you to ask. If SpaceX is really worth that much, why are they changing the rules to sell it to you? Why not just let the market decide? Stick around. This isn't about rockets. This isn't about Mars. This is about how the financial system quietly rewrote its own playbook. And your retirement savings? They could indirectly become part of the funding mechanism. Trust me, by the end of this video, you'll have strong opinions. Drop them in the comments. Here is the dirty secret. Nobody on CNBC is telling you. When people hear SpaceX, they picture rockets, Starship, Mars colonies, the future. But SpaceX isn't a rocket company. Not at its core. Not where your money is concerned. It is actually three businesses stacked on top of each other. The good, the bad, and the ugly. The rocket business? It is not even the most important one. We're starting with the ugly, because this part should make every investor furious. You know AI, Elon's artificial intelligence lab, started in Nantian to compete with OpenAI. Oh, and it owns X, the platform we all still call Twitter. A few months ago, SpaceX acquired XAI. It was an all-Dan stock deal. That means no cash changed hands, just shares. The combined company got valued at $1.25 trillion. XAI's slice, $250 billion. $250 billion. Pause. $250 billion for an AI company burning over $1 billion every single month. Let me put this in perspective. Numbers this big start to lose meaning. OpenAI generates roughly $20.4 billion a year, valued around $850 billion. That is about 30.5 times revenue. Expensive? Yes. But they're the market leader. Anthropic generates over $30 billion a year, valued around $400 billion. That is about 13 times revenue. Still pricey, but the revenue is real. XAI? Estimated revenue of $1 billion. Valuation? $250 billion. That is 250 times revenue, not 20.5. 250. To call that overvalued would be the understatement of the century. The market prices XAI like Emirates, but it operates like Spirit Airlines, with the burn rate to match. But the money isn't even the worst part. The people are. XAI launched with 11 CO-Dan founders, heavyweights from DeepMind, OpenAI, Google Brain, University of Toronto. This was the Avengers team of AI research. By March of this year, every single one had walked out, all 11, gone. Then Elon admitted on his own platform, XAI needs to be rebuilt from the foundations up. Let me translate that from CEO Dan speak to plain English. He paid $250 billion for an asset that needs to be rebuilt from scratch. I call XAI the reverse money printer inside SpaceX. It doesn't generate cash. It incinerates it. So while AI burns cash, the other two businesses are doing the actual work. Before you write this off, see the other two businesses. One is genuinely incredible. That contrast. That is what makes this story so dangerous. This is what you picture when you hear SpaceX. Falcon 9, Starship, NASA contracts. Astronauts going to the space station. Last year, rockets generated roughly $4 billion in revenue. $4 billion sounds like real money. It is. But against a $1.75 trillion valuation. That is not growth. That is fantasy. Rockets represent less than a quarter of total revenue. Yet the whole company is priced like Mars is already colonized. The engineering is mind-blowing. Reusable rockets change space forever. Historic achievement. But we're not talking engineering today. We're talking your money. The rocket business is a side hustle. Cool? Yes. Important? Yes. The reason for a $2 trillion valuation? Absolutely not. Cool, but not the cash cow. So where's the real money? Starlink. The crown jewel. The actual business. Think of it this way. What if Comcast but in space? Sounds like a venture capitalist tweet at 3 a.m. after too much espresso. Except Elon actually built it. And shockingly, it works. Starlink went beta in Nantian. 6 years later, it is the fastest scaling telecom company in human history. 10,000 satellites in orbit, each one beaming internet down to a dish on your roof. The dish points itself. You plug it in. You have broadband in the middle of nowhere, 10 million subscribers, roughly 150 countries. In 2025 alone, Starlink pulled in $11.4 billion. Read that again, 11.4 billion. Pause. 11.4 billion. That is 1% of SpaceX's total revenue. The rockets are the marketing. Starlink is the business. But here is what blows my mind, the margins. 2 years ago, Starlink ran 40% margins. Solid, respectable. This year, 60% They added 20 points of margin expansion in 24 months. In telecom, where margins usually get squeezed by competition, Starlink is getting more profitable as it scales. And it is not just consumers anymore. Maritime for ships and yachts, aviation for commercial airlines, and Starshield. That is a classified defense version. Active contracts at the Pentagon and the National Reconnaissance Office. Scott Galloway, who rarely compliments Elon, called Starlink the best tech product in years. He is podcasted from planes, FaceTimed from oceans. The product is legit. So is SpaceX amazing? Yes. Is it overvalued at $1.75 trillion? Also, yes. Both can be true. That is investing. That is reality. Starlink and rockets generated roughly $8 billion in profits last year. Fantastic. Then XAI showed up and lit it all on fire. When you consolidate everything, Starlink, rockets, and XAI, SpaceX lost nearly $5 billion last year on $18.5 billion in revenue. A company bleeding $5 billion annually is going public at the biggest valuation in history. Who is buying this? Not a sovereign wealth fund, not a hedge fund genius in Connecticut. For many everyday investors, index funds could end up absorbing these shares at peak valuation without asking you first. And here is why. On May 1st of this year, NASDAQ adopted something called the Fast Entry Rule. Sounds boring, right? Bureaucratic nonsense. Who cares? You care. Because this rule wasn't written for the market. It was written for companies exactly like SpaceX. The NASDAQ Yaotian isn't just a list of cool tech companies. It is a financial weapon. Over 200 ETFs and index funds track it. $600 billion in assets. When a company joins, every fund that follows the index is forced to buy, automatically. No debate. No discretion. Billions in guaranteed demand. Before the stock even opens. Under the old rules, new companies waited at least 3 months before joining. Why? Price discovery. Time for the market to trade the stock. Time to figure out what it is actually worth. Time for the hype to cool down. The fast entry rule cuts that wait from 3 months to 15 trading days. 15 days. That is not price discovery. That is a blind date where you're already married, already sharing a bank account, already signed the mortgage. But that is just rule 1. It gets worse. Rule 2. They eliminated the free float requirement. Free float. That is the percentage of shares actually available for the public to trade. It used to be that companies needed at least 10%. So the market could actually function like a market. SpaceX is targeting a free float of 4 to 5%. Under the old rules, automatic disqualification. They wouldn't even qualify for the conversation. Under the new rules, welcome to the index. Come on in, take a seat. And then there is Rule 3, the hidden multiplier. Buried so deep in the technical filings that most journalists missed it entirely. For companies with a free float under 20%, NASDAQ now treats the float as 3 times larger. For weighting purposes, think of it like this. A small float gets tripled in the eyes of index funds, effectively amplifying passive demand. Read that again. 4% gets weighted as if it were 12%. 5% gets weighted as if it were 15%. Let's put the whole picture together. SpaceX can join the NASDAQ Yaotian with only 5% of the company actually trading publicly. 6 months ago, that was an automatic disqualification. Now it is perfectly fine. They skipped the standard 3-month seasoning period. Just 15 trading days. No time for real price discovery. And ETFs are now required to treat that tiny float as 3 times bigger, creating artificial index weight, creating artificial demand that doesn't actually exist in the real market. 3 rules changed. Won't target SpaceX. This isn't a red carpet. It is a conveyor belt. And passive funds are strapped to it. But we're not done. Let's talk about who they're actually selling this to. Most IPOs allocate 5 to 10% to retail investors. Regular people, you and me. The idea is to give the public a small taste. Institutions do the heavy lifting. SpaceX is targeting 30%. 30% of the largest IPO in history. Going to retail, not to pension funds, not to university endowments. to everyday investors. And here is where it gets really uncomfortable. Brett Johnson, CFO of SpaceX, stood in front of a room full of investment bankers, said this on the record: "Retail is going to be a critical part of this IPO, bigger than any IPO in history. Retail buyers have been incredibly supportive of us and of Elon. We want to make sure we recognize that." Let me translate that from corporate speak to human English. We know our fans will buy anything with Elon's name on it. We know they don't read balance sheets. We know they think Mars and the future instead of profit and loss. So we're allocating 30% to them. Not because they help price stability. Not because they're sophisticated long-term shareholders. Because they're loyal. Because they might hold the allocation. That is not an investment strategy. That is admiration being converted into a liquidity event. Loyalty isn't a business model, but right now, it is being treated like one. For many passive investors, shares could be automatically allocated to you via index funds. If you hold any US stock index funds, and if you have a retirement account, you do. You'll likely own SpaceX within weeks of the listing. You won't vote on it. You won't choose it. You won't get a prospectus asking if you're interested. The mechanics of passive investing will buy it for you, automatically, relentlessly. Shares move from insiders sitting on a near-zero cost basis to passive funds and retail accounts, absorbing them at peak valuation. You're not the investor in this story. You might be automatically allocated shares without ever clicking a buy button. This brings us to the real problem. It is not SpaceX. It is the system that could force exposure without asking. When Wall Street sold you index funds, they pitched a beautiful story: low fees, instant diversification, set it and forget it, the triumph of common sense over overpaid stock pickers. And honestly, much of that story is true. Index funds democratized investing. They let normal people build wealth without finance degrees, without paying 2% management fees to some guy in a suit. But there was one part of the pitch they conveniently left out: the fine print, the same autopilot that buys the index for you. It also buys whatever gets added to the index, without your input, without your consent. Nobody sends you a survey. Hey, do you want to own this unprofitable rocket /Jan AI /Jan internet company at $2 trillion? The feature that makes passive investing convenient, the hands-off freedom, is the exact same feature that makes you a guaranteed buyer for any company connected enough to squeeze into the index. You wanted diversification. You might be getting dilution. You wanted safety. You might be getting automatic allocation. You wanted to beat Wall Street. Instead, Wall Street figured out how to use convenience against you. Convenience has a hidden cost, and that cost might be your portfolio. And right now, somebody squeezed in. Actually, multiple somebodies. OpenAI and Anthropic are reportedly planning public listings this year. Same configuration, low float, high valuation, manufactured demand. NASDAQ didn't rewrite the rules for one company. They rewrote them for an entire class. SpaceX was just first in line. The test case. The proof of concept. So here is the honest version. SpaceX is a mash-gen up of three businesses. One prints cash like a telecom monopoly. One breaks even but looks cool on YouTube. One burns $1 billion a month and lost all 11 founders. Combined, they lost $5 billion last year. They're listing at the largest IPO valuation in human history. And passive investors could be among the biggest buyers, not because they analyze the financials, not because they believe in Mars colonization, because the rules were changed so they have no choice. And the reason mainstream media isn't covering it this way, it is not clickable. SpaceX to go public at nearly $2 trillion. That is a headline. That gets clicks. NASDAQ rewrote float methodology to engineer passive demand for an unprofitable company. That doesn't trend. It doesn't fit a tweet. But it should make you think. So before you smash that like button, before you jump into the comments to tell me I'm wrong, and Elon is a genius who can do no wrong, ask yourself one honest question. If SpaceX is really worth $1.75 trillion, if the fundamentals are actually that strong, why did they need to change 3 rules to get index funds to buy it? Why not let the market decide? Why not trade for 3 months and prove its worth? Why not release more than 5% of shares to the public? Why not let real price discovery happen? Drop your answer below. I genuinely want to know. And if you're sitting there with a sitting LK or an IRA right now, does this make you want to log in and check what is inside your portfolio? Because passive investing was sold as freedom, as the smart, easy, no Jan stress way to build wealth. But right now, it is looking like a one-way ticket. And you might not be the passenger getting a ride to financial freedom. You might be automatically allocated shares without ever clicking a buy button. Hit subscribe if you want the real mechanics behind the headlines. Not hype, not fanboy stuff. The math, the rules, the fine print they don't want you to read. Because the next time NASDAQ changes the rules, and there will be a next time, it won't be front and page news. It'll be buried in a filing on a Friday afternoon, but we'll catch it. We'll break it down. And we'll make sure you understand what just happened to your money. I'll see you in the comments. And I have a feeling this section is going to be absolutely wild. Quick reminder, this video is for education and analysis only. It is not financial advice. I'm not telling you to buy, sell, or hold anything. Do your own research. Talk to a professional if you need to. Markets carry risk. Past performance doesn't guarantee future results. Stay sharp out there.